Have you ever noticed how the biggest, most shocking market events are the ones that nobody, and I mean nobody, saw coming? Well, that's exactly what we're going to get into today. We're not just talking about the usual market ups and downs. No, we're diving into the deep end, talking about those massive, unpredictable events that can literally define your entire financial life. This is all about preparing for the storms you'll never see on the radar.
All right, so here's our game plan. First, we're going to tear down one of the basic ideas of how risk is usually measured. Then, we're going to expose a really common myth about diversification that almost everyone believes. After that, we'll get practical and talk about how to actually build a portfolio that can take a punch. And finally, we'll take a peek inside the toolbox that the pros use to handle these exact kinds of challenges.
Okay, let's jump right in. To really get started, we have to challenge a fundamental assumption that a lot of us have about how markets are supposed to work. And this really comes down to understanding two incredibly powerful ideas that change absolutely everything: black swans and fat tails. So first up, the black swan. This term was really brought into the mainstream by the brilliant risk analyst Nassim Nicholas Taleb, and it's so much more than just a cool-sounding phrase. It perfectly describes those truly shocking events that seem to appear out of thin air and have consequences so huge that they completely rewrite the rulebook.
So what makes something a black swan? Well, Taleb says it boils down to three key things. First, it's a total outlier. It's something way beyond the realm of what anyone thought was possible. Second, its impact is just massive. And third, and this is the really wild part, after the dust settles, we humans have this amazing knack for looking back and creating these neat little stories that make the whole thing seem like it was predictable all along. That's our hindsight bias kicking into overdrive.
And if you look back, history is just littered with these things. Just think about it: the dot-com crash, the September 11th attacks, the 2008 global financial crisis, and of course the COVID-19 pandemic. Before they happened, they were pretty much unimaginable to most people. And afterwards, their impact completely reshaped our world and the markets for years, sometimes decades to come.
So why do our standard models seem to miss these things time and time again? Well, it all comes down to a big, kind of open secret in the world of finance. Market returns don't actually follow that nice, clean, predictable bell curve that so many financial theories are built on. On the left, you've got the classic bell curve from your old statistics class, right? It treats those crazy extreme events as basically impossible. But the reality of financial markets? Well, that's what you see on the right. See how the ends, the tails, are way thicker and fatter? That's not just a little visual difference. What it means is that these wild, massive market swings, both up and down, happen way, way more often than our standard models want us to believe. And look, this isn't just some abstract theory. As the investment firm AQR Capital Management puts it so bluntly, ignoring these tail risks is pretty much ignoring reality. And if you're building a portfolio without preparing for them, you're leaving yourself incredibly vulnerable to sudden, really painful losses.
Okay, so knowing that these fat tails are a real thing, what on earth does that mean for our portfolios? Well, it leads us to a really critical question. Is that so-called diversified portfolio of yours actually as safe as you've been led to believe? We're about to pull back the curtain on a very common illusion.
We're all taught the same thing. Diversify, diversify, diversify. You buy some stocks, you get some bonds, maybe you add a little real estate, and on paper, hey, that looks pretty well balanced. But the second you look under the hood and analyze where the risk is coming from, a completely different story starts to unfold.
This chart just says it all. Take a look at that pie chart on the left. That's a portfolio diversified by how much money is in each slice. Looks good, doesn't it? But now look at the middle chart. This one shows where the actual risk is coming from. And whoa, it is almost entirely from one place: stocks. So in a real crisis, this isn't a diversified portfolio at all, it's a stock portfolio in disguise.
And this brings us to a really fundamental shift in how we need to think. The real goal isn't just to spread your dollars around into different buckets, it's about balancing your risk. You want to build a portfolio where no single factor, not stocks, not interest rates, not inflation, can be the one thing that sinks the whole ship. That's the core idea behind what's called an equal risk allocation.
And the difference this can make in the real world is just enormous. This table shows a typical 60-40 portfolio versus an equal risk portfolio during two huge market crises. The traditional portfolio, it got absolutely hammered, down 17%, then down another 26%. But the equal risk portfolio, it held up incredibly well. It even posted a gain during the tech bust. That's the raw power of diversifying your risk, not just your dollars.
So if we just accept that we can't predict black swans, and we really can't, then our entire focus has to change. We have to move away from the game of prediction and get serious about preparation. So how do we actually build a portfolio that's fundamentally stronger?
Well, the research points to 3 core strategies. We've already talked about the first one, diversifying by risk, not just assets. The other 2 are just as important, actively managing volatility and finding and embracing investments that kind of march to the beat of their own drum. Let's take a quick look at those now.
So the next strategy is called active volatility management. The best way to think about it is like gently tapping the brakes when the road gets all bumpy and unpredictable. Instead of just holding on for dear life with a fixed amount of an asset, the goal is to keep your overall risk level more or less steady. So when markets get super choppy and volatile, you systematically reduce your exposure. And when things calm down, you can ease back in. It's a much more dynamic way to navigate the turbulence.
And that leads us perfectly to the idea of uncorrelated alternatives. This chart shows a strategy known as managed futures. Now, don't worry about the specifics of the strategy itself. The key thing to see here is its relationship to the stock market. See how all those dots are just scattered everywhere with no real pattern? That is exactly what you want to see. It means its performance isn't really tied to whether the stock market is going up or down. It has the potential to do well even when stocks are tanking, and that provides a powerful layer of protection right when you need it most.
All right, so for the last piece of the puzzle, to actually put these ideas into practice, the pros use a more advanced set of tools. You see, standard deviation, which is the typical way risk is measured, it just doesn't cut it when what you're really worried about are those extreme events out in the fat tails. We need tools designed specifically to measure what happens in the worst-case scenarios.
So let's look at 2 of the big ones. First, there's value at risk, or VAR. Think of VAR like drawing a line in the sand. It might tell you, okay, 95% of the time, we don't expect to lose more than this much money. But what about that other 5% of the time? That's where the second tool, conditional VAR or CVAR, comes in. It asks a much scarier, but way more important question. All right, on those days when we do cross that line, how bad is it actually going to be? It specifically measures the average loss in that worst-case zone, giving you a much clearer picture of the real danger you're facing.
So what's the bottom line here? If you remember just one thing from all of this, let it be this. Building a strong, resilient portfolio has absolutely nothing to do with trying to predict the next crisis. That crystal ball approach, it is doomed to fail every single time.
The real work, the important work, is in accepting that uncertainty and building a portfolio that's designed from the ground up to be resilient. The whole goal is to construct something that can withstand those inevitable shocks that you will never see coming. It's all about preparation, not prediction.
And that leaves us with one final, and I think crucial, question to ask yourself. We know, for a fact, that the next black swan is out there somewhere. And by its very nature, it is going to be a surprise. So the only question that really matters is your portfolio prepared for it?